Most people think the hardest part of retirement is saving enough money. But it's not. The real challenge starts when you retire, when your money starts to disappear and your options shrink. You've worked hard for years, saving and investing to build your retirement fund. You've reached your target, and you finally retire, thinking everything will be fine. But as soon as you start taking money out of your account to pay for everyday expenses, something happens. Your balance starts shrinking. You've been told the market goes up over time, so you think it'll come back. You tell yourself that the plan works and that the market will eventually recover. But over time, you start realizing something isn't right. By the time you're 65, you look at your account and wonder, how did I get here? Your options seem limited, and the future doesn't feel as secure as you thought it would be. This is the sequence of returns problem. In 2026, with the S&P 500 at high valuations, we could be facing a decade of flat or negative returns. This isn't just a theory, it's real. Investors like Howard Marks and Ray Dalio have been vocal about the risks ahead, warning that we might be entering a lost decade for markets. If your retirement plan depends on the market always bouncing back for you, this could be a major problem. Strategy 1. The index fund plus 4% rule. This is the classic advice. Put your money in low-cost S&P 500 index funds and withdraw 4% a year. It sounds simple and has been backed by studies like the Trinity study. The idea is that 4% will last for 30 years. But there's a big problem. The market today is different. The prices of stocks are high, and experts like Howard Marks and Ray Dalio warn that we might be facing a lost decade for markets. Here's what can go wrong. If the market drops early in your retirement and you still keep withdrawing money, you're forced to sell your investments at a loss. If you start with $1 million and the market drops 40% in the first year, now your balance is $600,000. To get the same $40,000, you'd need to withdraw 6.7% instead of 4%. This isn't sustainable, especially over the long run. Strategy 2. The income factory. The income factory strategy focuses on high-yield investments like covered call ETFs, CLOs, and closed-end funds. The idea is simple. Get income without touching your principal. But there's a catch. These high-yield funds haven't been tested in a long-term market downturn. If the market crashes, the income can quickly dry up. It's like running a business on borrowed money. If the market crashes, you may have to sell at a loss, permanently damaging your portfolio. During the 2020 market crash, some high-yield funds had to sell assets at the worst possible time. This strategy looks good in a bull market, but can fail when things go south. Introduce the third strategy. In 2026, the strategy I trust most is the Dividend Growth Machine. This isn't about chasing the highest yield. It's about investing in businesses with strong, reliable cash flow that can grow dividends over time. Take Barbara, a teacher, for example. She built her portfolio by investing in companies that had raised their dividends for 10+ years. She focused on companies with solid business models, like utilities, pipelines, and real estate with long-term contracts. These companies did well in both good and bad markets. The dividend growth strategy isn't about high yields, it's about consistency. You invest in companies that can raise their dividends year after year, even during tough times. This way, if the market drops, you still get a steady income. Barbara's approach wasn't flashy, but it worked. She didn't rely on the market's short-term movements. She knew her dividends were safe because she invested in businesses that could handle any market condition. The strategy I trust is called the two-pile system. The first pile is your foundation layer, diversified, lower volatility, dividend-growing assets. These form the core of your income. The second pile is a yield enhancement layer, a smaller portion of your portfolio that boosts yield without risking your entire portfolio if things go wrong. For example, you could use Schwab's U.S. Dividend Equity ETF, SCHD, as your core.
It gives a solid 4% yield and has a 10-year history of growing dividends. On top of that, you can add exposure to infrastructure, utilities, and maybe some tech-focused funds. Let's say you're 58, have $1.2 million to invest, and need $7,000 a month in passive income. Here's how you could allocate it. 30% in SCHD, $360,000, yielding 4%, equals $14,400 per year. 15% in utility-focused closed-end funds, $180,000, yielding 6.5%, equals $11,700 per year. 10% in JEPI IQ Covered Call ETF, $120,000, yielding 10%, equals $12,000 per year. 20% in midstream energy companies, $240,000, yielding 7%, equals $16,800 per year. 15% in triple net lease real estate, $180,000, yielding 5%, equals $9,000 per year. 10% in business development companies, $120,000, yielding 9%, equals $10,800 per year. Total annual income, roughly $74,700, with a blended yield of about 6.2%. This is close to the $7,000 a month target. Plus, with dividend growth, you'll likely hit the target in 2 to 3 years. You might be thinking, this sounds like more work than just buying an ETF and letting it ride. And yes, it does require more monitoring than a simple passive fund. But consider this. What's more work than managing a dividend portfolio? Running out of money at 70 and having to go back to work. Audit your current retirement plan for sequence of returns risk. If it relies too much on early market gains, it's time to rethink it. Diversify your income across different sectors. Don't put all your eggs in one basket. Require dividend growth in your investments. A growing dividend is much better than a flat yield over time. Retirement income isn't about chasing the highest yield. It's about building a solid income machine that can survive any market storm and keep paying you for years to come.